Hi there. Well, I thought today we could chat a little bit about volatility. And today, the 5th of May, happy Cinco de Mayo. But if you're looking at the news, you're certainly seeing a lot of volatility. And, Eric and I did a piece about a month or so ago, just a general chat that we had and put on the website and shared with you of all, talking about volatility from a general concepts and strategy standpoint. But today I wanted to dig a little deeper and answer the question that we're getting a lot right now, which is, what's happening? Why are we seeing these levels of volatility? How long do we think it's going to last? What's behind it, etc. So let's dive a little bit into that. I promise I'll try to be brief, but also give you our perspective as to what's happening. So when I get that question from clients, typically I start off by sharing some perspective around historical volatility. And historically, when we see a lot of volatility within the markets, usually it's a cumulative impact from a number of small-ish factors that together they're able to move the dial. It's usually not one issue that has the impact to actually move the dial. Now, once in a while, we do see that, and actually, COVID was a good example of that. In 2020, the markets were, in great shape. We saw, returns coming off of 2019, and then when COVID hit at the end, kind of towards the end there of Q1, we saw a massive downturn, massive volatility in the market. We saw then a lot of government stimulation, and we saw a massive upswing. That whole cycle was measured in weeks, and it was really that one primary factor of a global pandemic. But that's not usually the case. Usually the case is what I said earlier, which is it's a cumulative impact of a number of smaller factors. Well, in today's economic and world and in today's markets, we actually have three factors, three issues that are present that all in and of themselves are significant enough to move the dial. So let's kind of dissect those individually and talk about each of those briefly. So we all know that 2020, although it was a very odd year, I guess is an appropriate word in a number of ways, from a market perspective, we saw a lot of growth in 2020, phenomenal growth. The second half, Q3 and Q4, we saw massive growth. We ended the year at the end of Q4 there at a record high, market all-time highs. Again, we saw a repeat in 2021 where the markets were consistently up throughout the year. We ended 2021 at an all-time high. Markets had peaked. Valuations were extremely high. I share that because, those valuations, that market was extremely high. Q4 of 2021, we saw those all-time highs, but it got there via a lot of government intervention. 2020, we saw it. 2021, we saw it again, to the tune of literally trillions upon trillions of dollars, and the government just flooding the markets with money. So we had a market that was really pumped up artificially. When you get those high prices and they're pumped up artificially, they've got to get back to a fair price. There's only two ways for that to happen. We either see a correction, as the name implies, it corrects the market goes down and it corrects back to a fair price, or we see the market essentially go sideways for a period of time and the underlying economics improve, so then those valuations are fair. But the market always writes itself to a fair price. So that is issue number one. We ended 2021 with an overpriced market by any stretch of the imagination, any valuation process, and the market needed to get back to a corrected fair valuation. The second factor was, with all the stimulus that was happening, we saw inflation and interest rates starting to rise in 2021. Inflation that we're seeing now should not be a surprise. This was forecasted, very easy to see that inflation was looming. So we saw inflation really start to take hold in 2021. And correspondingly, we saw a number of rate increases in 2021 and continuation into 2022. That is a big change from where we had been for over a decade. We had over a decade of extremely low inflationary numbers and the cost of money and interest rates being extremely low. That dial has moved. So now we're seeing interest rates much higher. If you go and look at a 30-year mortgage today versus what it was a year ago, it's a drastic difference. So the cost of money is going up, interest rates are going up. That alone has an impact on the market that is significant enough to create a pretty significant level of volatility. And that again is probably here to stay. As you listen to the Fed, their job is not to surprise the world as to what they're going to do. They're actually forecasting and talking about where their thought process is and what actions they might take in the future. So we saw a big rate increase yesterday, and that again shouldn't have surprised anyone because that was forecasted. So the second factor causing volatility in the markets is rising interest rates and the inflationary numbers. Well, then we've got the third factor that caught most of the world by surprise, and that is the unfortunate situation that's happening with Russia and Ukraine. And if we put the humanitarian issues aside for a minute and just focus on the economic side, Russia is a massive provider of oil to the world, both to the U.S. and certainly to European countries. So when you have the U.S. and Europe basically saying, we are no longer going to do business with you, we are no longer going to purchase oil from you, or we're going to transition, in the UK's part, if we're going to transition away from this provider, we have supply issues, right? There's supply issues, there's demand issues, that creates pricing issues because this is a massive scale of oil production. On the Ukraine side, we also have a big distribution of natural resources that has also been slowed down, that then again has a ripple effect globally. But oil is obviously a big, big deal. There's not an easy solution to oil. It's not it's not like those of us as individuals, right? There's gas stations everywhere. We can get it everywhere. But it's got to come from somewhere. And there's very limited places where that level of oil or supply can come from. And when you look at the US saying, okay, how do we solve this problem? Sure, we can open up reserves, which the US has done. Those are short-term fixes. The long-term fix is very difficult. I doubt that even if Russia changed its stance and said, we're going to go home and we're really sorry, I doubt the US would say, okay, we're going to do business with you again. I doubt European countries would say, okay, we're going to do business with you again. So I think some bridges have been burned here, and I think there's going to have to be, more of a long-term solution. The long-term solutions are not easy. Talking about ramping up U.S. supply to meet our demands, that's not like flipping a light switch where we can do that and next month have that be all online and ready to go. That will take time. That will take policy change, and that will test the patience of quite a number of U.S. citizens. The other option, going out and finding another supplier, they're very limited. There's no easy way to say it. The folks or countries that have that level of supply that we potentially could do business with would also cause a lot of concerns to a lot of U.S. citizens and folks abroad. So there's not an easy solution to changing the international oil supply, and that's going to take some time. So when you put those three factors together, like I said, all of them individually are enough to move the dial on the markets and cause volatility. We have all three of those happening at once. So we are seeing a lot of volatility. Yesterday and today, I think, are very good cases in point. Yesterday, we saw the markets go up over 2% after the Fed announced a rate increase, which is definitely counterintuitive and obviously too high. Today, we're seeing the markets pull back, and they're down 3 to 4%. We're looking at double-digit decline so far year to date. Both in the stock sector and the bond sector is approaching a double-digit decline, which we have not seen for over a decade. So bonds and interest rates, as interest rates go up, value of bonds go down. So we're seeing a lot of movement, downward movement in the fixed income arena this year as well. So volatility is here. I don't think this is going to be measured in days or weeks. It was measured in weeks when we saw a big volatility like this in 2020. I don't think this volatility cycle will be measured in days or weeks or even months. Here we are, end of month 4, starting month 5, and it's here. This I do think will be measured in quarters, if not that kind of year to 2 year type of time frame. So our perspective is really volatility is going to be here for a while. We need to prepare and deal with that. I'd also be extremely surprised, pleasantly surprised, but I'd be extremely surprised if we see the markets able to, recover where they're at, given the year-to-date numbers by December, and then turn a positive corner. That would surprise me. Like I said, I'd be pleasantly surprised, but I would definitely be surprised. A lot of folks ask us, what are we doing? So we're continuing to put our best foot forward with adjustments to the strategy. And I've shared with some folks individually in a typical environment, uh, pre-COVID world, we're typically when we're looking at, so we're reviewing strategy every 90 days, every quarter. And usually there's two out of four quarters a year where there's enough change in the markets that then warrants change at a portfolio level. In 2020, we had five strategic changes. 2021, we had five strategic changes. So far, year to date in 2022, we've already had two. So the past, 2.5 years, we've seen 12 strategic changes to the portfolios that we're managing for clients, where typically we'd see three or four. So a lot of change to the strategy at a strategic level and an investment level, but it's warranted, given the amount of change that we've seen over the past, 24 months. So that's one piece of what do we all need to do as investors. We need to make sure our strategies are up to date, they're current, and that we're putting our best foot forward in that front, which for our clients, you can rest assured that we are. And then the other one, candidly, is time. Every cycle is a period of time. We just don't know what those periods of time are. Like I said, this one, we're kind of 4 months plus in. And my guess is that we'll be in this cycle for a while. We just don't know how long that time frame is. But at some point, we will turn the corner and we will be back into a growth mode. Again, I just don't know when that is. So I wish I had a crystal ball for you on that one, but I don't. But again, I think as clients, you can rest assured we're putting the best foot forward. Strategies are up to date. And this cycle, like every other market cycle, will have a beginning and it will have an end. If you do want to talk to me individually or anyone on our team, as always, please do feel free to reach out. And yeah, we definitely look forward to our conversations and meetings with you all and hope you enjoy the rest of your day. Thank you. Take care.